Hi everyone, Chapter 2. If there is a chapter that is the most important chapter in the book, this is it. So if you're going to spend time on a chapter, really reading it and truly understanding it and going over it again, this is the one. Because accounting is foundational. This is the chapter you learned how to do debits and credits. You know, going on from here in future chapters, you're going to be assumed to know debits and credits. So this is a point that you need to spend time on this chapter. I'd say like order of priority, Chapter 2, Chapter 3, and Chapter 4 are probably some of the most important chapters in the text. Okay, so spend time here. All right, really challenge yourself with this material. All right, so the beginning of the accounting cycle is where we're starting here. And what we're really doing is we're going to analyze business transactions by preparing journal entries. And we prepare those journal entries in, what we call it journalizing. We do that in the general journal. All right, accounting likes to use a lot of the same words. So we're going to be preparing journal entries, and that's called journalizing in the general journal. After we prepare the journal entries, we're going to post to ledgers, and then we'll prepare the trial balance. And that's the section of the accounting cycle that we're going to be working on throughout Chapter 2. Starting with Chapter 3 and whatnot, I will show it to you more as a full cycle. But for now, let's just focus on the journal entries. All right, so the accounting equation. We did this, right? Assets equal liabilities plus stockholders' equity. We covered that in the last chapter, but now we're going to see it in a lot more detail. Typical assets, like we said, cash, buildings, supplies, accounts receivable, land. I know we haven't really defined what accounts receivable are yet. You'll see that as we go through this. What else? Liabilities, for lack of a better way of putting it, anything with the word payable on the end of it is a liability. Also, unearned revenue. All right, so anything with the word payable on it, taxes payable, salaries payable, wages payable, and so on, and unearned revenue. Stockholders' equity, right? You've got revenues. Well, stockholders' equity is a couple of things, but if you want to think about it this way, stockholders' equity, you think about the things that belong in stockholders' equity. One of those things is revenues. Revenues increases stockholders' equity, right? Revenues is money that you earn. It brings up the value of your business. Expenses bring down the value of your business. Capital stock. Capital stock is what a business gives someone when they put money into the business. So if I were putting cash into the business would then turn around and give me back stock in the business. So capital stock really refers to when somebody puts an asset into your business, usually cash. And you'll see that with some transactions. But the idea is it definitely brings up the value of your business when somebody puts money into it, right? And on the flip side, when the business pays money back out to its owners, it's called dividends. And then dividends brings down the value of the business because it's money coming out of your business. Okay, so just a little quick try it here. Well, normally I'd have you do this live in a classroom, but just to kind of give you a quick rundown. Notes receivable. All right, you go back here, receivables. Let's talk about what receivables are now. May as well do it now. The idea of receivable is someone owes you something. So an account receivable is somebody owes you money. You're waiting to receive it. A note receivable means also somebody is waiting to give you money. Accounts receivable happens as a normal part of business, right? You send a bill, somebody owes you money, that's an account receivable, they pay you, good, right? Notes receivable is a little bit more formal. It's when someone owes you money and you're like signing a note, like I owe you $10,000 or something like that. So regardless, a receivable is an asset. Stock, we just said, that's stockholders' equity. Prepaid insurance. Let's talk about prepaid insurances. Prepaid insurance is when anything prepaid really is when you pay for something in advance. Very often you have to pay your insurance for upfront, like for a year or 6 months. If you want to buy magazine subscriptions, you normally have to pay for that in advance. Anything like that is called a prepaid item, and that is an asset to you. Right? You've paid in advance for something. Notes payable, I told you before, anything with the word payable on the end of it's a liability. Revenue, stockholders' equity. Anything with the word payable on it is liability. Expenses, that falls into that stockholders' equity section. Remember, it's revenues, expenses, dividends, capital stock, right? So that's stockholders' equity item. Furniture is an asset. Dividends, stockholders' equity item. Unearned revenue, liability. Okay, so if you're not sure about any of those, go back to the previous slide and take a look. All right, so let's talk about T accounts for a second. You'll see me using T accounts all the time because it's a helpful way to organize information. It's a helpful way to learn how to do journal entries. So the idea of a T account is you'll have an account title at the top. You'll see debits will be on the left, credits will be on the right. That's always going to be the case. All right. So for example, let's say you had the T account of cash. All right. Debits are on the left, credits on the right. The thing is, it depends on what kind of an account is as to whether or not debits increase or decrease, or whether or not credits increase or decrease. So for example, cash. An increase to cash is a debit. A decrease to cash is a credit. So, for example, let's say we put $500 went into our bank account. That's going to be a debit. And then let's say we took money out. That's going to be a credit. It's going to decrease the value of that account. All right, let's say we put more money in. That's going to be a debit. All right, and the idea, the way this works, a T account, is you'll add up all your debits and you'll add up all your credits and you'll subtract one side from the other. So in this case, you had $800 in debits and $200 in credits. You subtract the two from each other, and that will leave you a $600 debit balance. All right, that's going to be the normal balance of that account, is going to be a debit balance because you either have cash or you don't have cash. You usually wouldn't have negative cash. All right. So what is a debit? The only thing that debit means is left side. And the only thing that credit means is right side. That's it. Okay? Like I said, it depends on what kind of an account it is as to whether or not a debit is an increase or a decrease, or whether or not a credit is an increase or a decrease. All right. I'm not going to make you watch this video, but I will show you that it's here. You should look this up on YouTube because you will never forget what side is what after watching this video. But I'm not going to force you to watch it on here. All right, this slide right here is the most important slide probably in the chapter. Put an asterisk on it, star it, flag it, whatever you need to do, because this is the one you can go back and forth to as you're preparing your journal entries. All right, so we've got assets equal liabilities plus stockholders' equity, and we know that's our accounting equation. To increase an asset is going to be here on the debit side. To decrease an asset is going to be on the credit side. On the flip side of that, realize we're on the flip side of the equation. A debit decreases a liability, but a credit increases a liability. Stockholders' equity follows the same rules as liabilities. A debit is a decrease, a credit is an increase. Don't think plus and minus, think increase and decrease. All right, it's just a little bit easier to think about it that way. So let's take a step further. Let's look at the items in stockholders' equity that decrease or increase. As you might think, common stock, if somebody puts money into the business then turns around and gives them back stock. That is going to be a credit because that is going to increase the value of your business, right? Because someone is putting money into your business. So that will be a credit that increases stockholders' equity. Revenues, right, also increase stockholders' equity because it's money that your business is earning. On the flip side, dividends will always be a debit. And I know it's a plus here because the idea is that your journal entry will always be a debit. But if you look at what dividends are, they are inherently a negative, meaning that dividends are when money gets paid out of your business, so it brings the value of your business down. So if you are going to be doing anything with dividends, you're going to be debiting them. The same thing goes for expenses. Again, I know it's a plus here, and I know that can be a little bit confusing. As we start using it, you'll see as we go through. So you've got this debit to expenses because expenses also bring the value of your business down. So that is inherently a negative. Okay. How do we do this? How do we prepare these journal entries? Well, there's some steps here. You have to determine what accounts are affected. So if you remember from chapter 1, what we did was we did some increases and decreases. We said it always affected at least 2 accounts, right? Like assets went up, but liabilities went down or whatever, back and forth. We said this increased, that decreased. Well, now what we're going to do is we're still going to pick those 2 accounts. We're going to decide if it's an increase or a decrease, and then we'll start using the words debit and credit. So let me give you an example. Let's say we buy supplies on account for $100. Now, when you see the words on account, you'll always think account payable or account receivable. I want like a little bell to go off in your head that says on account means accounts payable or accounts receivable. Well, do I owe the money, which is an accounts payable, or am I getting money, which is an accounts receivable? So let's look back at this. Buy supplies on account for $100. So we're getting supplies and we owe somebody, Staples, whatever, $100. That's going to be an account payable. So what we do is we figured out which two accounts are affected. We've got supplies and we've got accounts payable. Now, what are we increasing them or decreasing them? So supplies and accounts payable. Well, we're increasing supplies because we're getting supplies, right? So that's a plus, an increase. And we're also increasing our accounts payable. We have a liability where we did not have one before. All right, so we're increasing both of those accounts. So if we look over here, that's going to be an increase to the asset account of supplies. So that's a debit. And an increase to the liability account of accounts payable. That's your credit. Okay, so you have to think about what accounts are affected. Is it an increase or a decrease? And then is it a debit or a credit? So your journal entry would look like this, or rather the T account. You'd have supplies, you'd be debiting supplies for the $100 and crediting accounts payable for $100. And that's it. Okay? So take your time getting through this slide and getting a better understanding of it and using it to go through the next bunch of problems. All right. I have a little bit of a try it here. I'm going to give you the solutions, but I'd like you to try it on your own. Okay? On to the next video.